Silver is once again becoming the center of attention in global financial markets, and this latest move higher is creating a wave of excitement among investors, traders, and everyday people looking for protection against economic uncertainty. What makes this rally especially interesting is not just the speed of the move, but the growing belief among analysts that silver may still be in the early stages of a much larger bull market. After months of volatility and sharp corrections, silver has climbed back toward the spotlight, outperforming gold in recent trading sessions and triggering discussions about whether triple-digit prices could eventually become reality. At the start of the trading session, silver was sitting near $81 an ounce, gaining more than $2 in a single day. That kind of movement immediately grabs attention because silver is known for its volatility. When it moves, it tends to move aggressively. Gold also pushed higher, but at a much slower pace, showing once again that silver often acts like a high-powered version of gold during precious metals bull markets. Investors watching the gold-to-silver ratio noticed something important happening as well. The ratio dropped below 60, signaling that silver has started to outperform gold more aggressively. Historically, this kind of movement has often marked periods where silver enters powerful rallies that surprise even experienced traders. For many investors, the gold-to-silver ratio acts as a roadmap for deciding which metal offers better value. When the ratio is extremely high, silver is often considered undervalued relative to gold. When the ratio begins falling rapidly, it usually means silver demand is accelerating. That is exactly what markets appear to be witnessing right now. Some investors who previously focused equally on gold and silver are now shifting strategies entirely because they believe silver's upside potential is much larger in the coming years. One of the most important details investors are paying attention to is how quickly silver recovered after its recent dip. Earlier in the week, prices briefly fell into the low 70s before bouncing back nearly $9 in just a few days. That type of recovery suggests strong buying pressure underneath the market. Every time prices dip sharply, buyers seem ready to step in. That is often considered a bullish signal because it indicates investors are treating pullbacks as opportunities rather than reasons to panic. Several macroeconomic factors are also helping fuel the move higher. Oil prices have been weakening recently, while the US dollar index has also slipped lower. Precious metals typically benefit from a weaker dollar because metals become cheaper for international buyers using foreign currencies. At the same time, lower oil prices can reduce inflationary pressure on manufacturing and transportation costs, creating a more favorable environment for industrial demand growth. Since silver is both a precious metal and a critical industrial commodity, it tends to respond strongly to shifts in both economic and monetary conditions. Another major factor driving optimism is the surprisingly strong labor market data coming from the United States. Recent non-farm payroll numbers showed stronger than expected job growth, calming fears of an imminent recession. This matters tremendously for silver because, unlike gold, silver depends heavily on industrial activity. A recession could weaken manufacturing demand, electronics production, and solar panel expansion. But if economies continue avoiding recession while maintaining industrial growth, silver demand could continue accelerating. That industrial demand story may be the single most important reason why analysts are becoming increasingly bullish on silver's future. Around the world, governments and corporations are pushing aggressively toward electrification, renewable energy, artificial intelligence infrastructure, robotics, electric vehicles, and advanced technology manufacturing. Silver plays a critical role in all of those industries because of its unmatched electrical conductivity. Nearly every modern technological system depends on silver in some way. Solar energy remains one of the biggest drivers of future silver demand. Solar panels require significant amounts of silver paste to conduct electricity efficiently. As countries race to expand renewable energy infrastructure, silver consumption in the solar industry has exploded. Electric vehicles also use much more silver than traditional gasoline-powered cars because of the extensive electronic systems inside them. Artificial intelligence data centers, robotics, telecommunications networks, and advanced semiconductor manufacturing all require silver components as well. What makes this situation particularly interesting is that silver supply is struggling to keep up with the pace of demand growth. Unlike gold, which is primarily stored and accumulated, silver is heavily consumed in industrial processes. Much of the silver used in electronics and manufacturing is not economically recoverable after production. That means large amounts of silver effectively disappear from available supply over time. Meanwhile, mining production growth has remained relatively slow despite rising demand. Analysts increasingly warn that the world may be heading toward a structural silver deficit. In simple terms, demand could continue exceeding available supply for years. When that happens in commodity markets, prices often rise dramatically because buyers begin competing aggressively for limited inventory. This is one reason why many precious metals analysts believe silver's long-term upside remains enormous despite already strong price gains. China's role in the silver market has also become impossible to ignore. Reports showing massive silver purchases from China are attracting global attention because China is one of the world's largest manufacturing economies. According to market analysts, China recently imported hundreds of tons of silver in a single month, far above normal levels. That type of buying activity suggests serious concern about future supply availability. Many experts believe Chinese manufacturers are attempting to secure silver supplies before prices rise even further. China dominates global production in industries such as solar panels, electronics, batteries, and electric vehicles. All of these industries require large amounts of silver. If Chinese companies fear future shortages or dramatically higher prices, they have strong incentive to accumulate silver aggressively while they still can. There are also reports that China has tightened restrictions on silver exports, reducing the amount of metal leaving the country while simultaneously increasing imports. That combination effectively locks more silver inside China's domestic economy. Analysts see this as a strategic move designed to protect manufacturing industries from future supply disruptions. At the same time, silver inventories inside major global trading hubs appear to be shrinking. Warehouses in London, Shanghai, and North America have reportedly experienced steady drawdowns over recent years. Lower inventory levels create additional pressure on the market because there is less buffer available during periods of high demand. If another major buying wave enters the market while inventories remain tight, prices could spike rapidly. One of the biggest discussions among silver investors right now revolves around the possibility of another silver squeeze. This term refers to situations where demand overwhelms available supply, forcing prices sharply higher in a short period of time. Previous silver squeezes created explosive rallies that shocked financial markets. Some analysts believe the world could experience another major squeeze within the next few years if industrial demand continues accelerating while supply remains constrained. The psychological side of the market is also important. During the recent rally above $100 an ounce earlier in the year, massive momentum buying entered the market. Retail investors, hedge funds, and institutional traders all rushed into silver simultaneously. Prices eventually corrected sharply afterward, but many analysts argue that the correction simply removed speculative excess while leaving the long-term bullish fundamentals intact. According to several market experts, what happened recently was not the end of the bull market, but rather a temporary pause before the next leg higher. The argument is that industrial demand trends remain stronger than ever, while investment demand is only beginning to expand globally. If investment demand returns aggressively at the same time industrial users continue buying heavily, the market could face severe supply pressure. Another important point involves affordability. Gold prices have risen so dramatically that many smaller investors around the world are turning their attention towards silver instead. Historically, silver often attracts waves of retail investment during precious metals bull markets because it appears cheaper and offers greater percentage upside potential. Analysts believe this shift could become especially powerful in Asian markets, where cultural demand for precious metals is already deeply rooted. Some experts are even projecting silver prices could eventually reach several $100s per ounce over the next few years. While such predictions sound extreme, supporters of this view point to historical ratios and previous commodity supercycles. One commonly discussed metric compares the price of the S&P 500 stock index to silver. Historically, during periods of major financial stress or commodity booms, silver dramatically outperformed equities. Currently, it takes roughly 100 ounces of silver to equal the value of the S&P 500 index. Some analysts believe that ratio could eventually fall to 20-to-1 if silver enters a full-scale bull market while stock markets stagnate or weaken. Based on current index values, that scenario could imply silver prices approaching $370 per ounce, 0.370-207,396. Of course, projections like these remain highly speculative, and markets rarely move in straight lines. Silver is notorious for extreme volatility. Large price swings in both directions are common, and investors should always recognize the risks involved. However, what makes the current environment unique is that multiple powerful forces appear to be aligning simultaneously: industrial expansion, renewable energy growth, artificial intelligence infrastructure demand, tightening inventories, strong investment interest, and geopolitical uncertainty. Geopolitical tensions are another hidden driver behind rising precious metals demand. Around the world, conflicts and trade disputes continue creating uncertainty about supply chains and global economic stability. During uncertain times, investors often seek hard assets that cannot be printed or digitally manipulated. Gold traditionally benefits most from that behavior, but silver frequently follows with even greater volatility once momentum builds. Some analysts also argue that silver remains historically undervalued compared to other financial assets. Over the last several decades, stock markets massively outperformed precious metals, but market cycles eventually rotate. If confidence in traditional financial assets weakens while inflation concerns remain elevated, investors may increasingly turn toward tangible assets like silver and gold. Physical silver ownership is becoming another major topic of discussion. Many analysts stress the importance of owning actual physical metal rather than paper-based investment products. Their concern centers around counterparty risk. In times of financial stress, some investors worry that paper contracts, ETFs, or synthetic financial products may not provide the same security as directly owning physical bullion. This growing preference for physical ownership has already contributed to increased demand for coins and bars. Bullion dealers around the world have reported strong sales activity whenever silver prices experience major pullbacks. Investors appear increasingly interested in accumulating physical metal for long-term protection rather than simply speculating on short-term price moves. Another interesting aspect of the silver market is how emotional and psychological it can become. Unlike larger markets such as bonds or major currencies, the silver market is relatively small. That means shifts in sentiment can create disproportionately large price movements. When fear or excitement enters the market, silver can move with incredible speed. That volatility often scares away conservative investors, but it also creates opportunities for traders willing to tolerate risk. Throughout history, silver has experienced some of the most dramatic rallies of any major commodity. During previous bull cycles, prices multiplied several times over in relatively short periods. While history never repeats perfectly, many analysts believe silver could once again surprise the financial world. What happens next will likely depend on several key variables. If the global economy continues expanding without falling into recession, industrial silver demand could remain extremely strong. If central banks continue weakening fiat currencies through monetary easing or debt expansion, precious metals could attract additional investment flows. And if supply deficits continue widening, physical silver availability may become an even larger issue. Investors are also closely monitoring interest rates. Lower interest rates generally benefit precious metals because they reduce the opportunity cost of holding non-yielding assets like silver and gold. If central banks eventually pivot toward rate cuts to support slowing economies, precious metals could receive another powerful boost. At the same time, silver's relationship with technology trends cannot be ignored. The future global economy is becoming increasingly electrified and digitized. Artificial intelligence systems require massive computing infrastructure. Electric grids are expanding. Renewable energy installations continue growing. Robotics and automation are spreading across industries. Nearly all of these technologies require silver in some form. That means silver is no longer simply a traditional precious metal story. It is also a technology and industrial growth story. This dual role gives silver a unique position in global markets. It can benefit from both economic expansion and financial uncertainty at the same time, depending on circumstances. Some market veterans believe the world is entering the early stages of a long-term commodity supercycle driven by resource scarcity and industrial transformation. If that view proves correct, silver could become one of the most important commodities of the next decade. Supply constraints combined with exponential technology demand could create conditions rarely seen in modern financial history. For now, traders remain focused on short-term price action. Every move above resistance levels creates fresh excitement, while pullbacks continue attracting buyers looking for entry points. Market sentiment has clearly shifted from fear during the recent correction to renewed optimism about future upside. Whether silver ultimately reaches $100, $200, or even higher remains uncertain. But one thing is becoming increasingly clear: silver is no longer being viewed as just another commodity. It is rapidly emerging as a strategic resource at the center of technological transformation, industrial growth, and global financial uncertainty. As prices continue fluctuating, investors around the world are watching closely. Some see silver as protection against inflation and currency devaluation. Others view it as a high-growth industrial asset tied to the future of energy and technology. And many believe the market is still underestimating how tight global supply conditions may become in the years ahead. The coming years could determine whether silver truly enters a historic supercycle or whether the market cools off after its recent surge. Either way, the growing attention surrounding silver reflects a much larger story about the changing global economy, the race for technological dominance, and the increasing importance of hard assets in an uncertain financial world.